Gold is approaching a major liquidity zone, and right now, smart money may already be positioning ahead of the next big expansion move. Welcome to today's institutional market breakdown. In this explainer, we're going to apply a professional top-down approach to gold. We'll be analyzing the fundamental drivers, institutional order flow, and specific smart money concepts so we can map out our next high-probability actions. Let's dive in. Like I just mentioned, gold is sitting right on the edge of a critical liquidity zone. This suggests that smart money is actively positioning for the next major expansion. Listen, we aren't interested in retail noise here. What we're actually looking for is displacement, mitigation, and clear institutional footprints. For our briefing today, here's what we're looking at. We'll cover the macro context and fundamentals, the top-down market structure, and a really important timeframe conflict. Then, we'll map out both institutional sell and buy setups, and wrap up with execution and risk management. Okay, let's start with Section 1, Macro Context and Fundamentals. We're seeing some severely conflicting macro drivers in the market right now. It's really a fundamental tug-of-war. On one hand, we've got sticky US inflation. Headline PCE is at 3.8% and core is at 3.3%, which is fundamentally boosting the US dollar. But on the other hand, geopolitical tensions in the Middle East, specifically those on approved ceasefire drafts and renewed CENTCOM strikes, are providing a strong underlying safe haven support for gold. And this exact friction is what creates the volatility and liquidity pools we want to target. Because of that persistent inflation, traders are actively pricing in expectations of prolonged higher interest rates. Looking at the CME Fed Watch data, the market is pricing in roughly a 36 to 50% probability of another 25 basis point hike by the end of the year. So this expectation of a stronger yield curve is fundamentally limiting gold's upside potential. It's essentially acting as heavy macro resistance right now. Plus, when we look at today's economic calendar, we've got a heavy slate of FOMC speakers lined up, everyone from Kashkari to Daly, alongside some key GDP data. Now, for an institutional day trader, this guarantees significant intraday volatility. We don't trade the news itself, but we know these events act as the catalyst for smart money to sweep liquidity right before moving price to its real intended target. Moving right along to Section 2, Top-Down Market Structure. Zooming out to the 4-hour time frame, the overarching macro structure here remains firmly bearish. You can clearly see this undeniable sequence of lower highs and lower lows. That massive drop we had recently pushed prices all the way down to the 43.75 level, and right now, strong institutional supply is resting just above us in that 4,500 to 4,520 premium zone. The EMAs are acting as dynamic resistance too, which just completely confirms our bearish bias on this time frame. But when we drop down into the 1-hour time frame, it reveals a steep, bullish macroeconomic retracement bouncing right off those 43.75 lows. It's actually broken right through the short-term moving averages, showing some pretty strong upward momentum. So suddenly we have a direct conflict with our higher time frame bias. And that brings us to Section 3, the time frame conflict. Understanding this trap is absolutely crucial if you want to protect your capital. We're dealing with a severe time frame conflict here. Think about it. Buying blindly right now means stepping directly into 4-hour institutional resistance and major supply zones. But conversely, selling blindly means stepping right in front of a freight train of 1-hour bullish momentum. However, we are starting to see fading bullish momentum and MACD divergence. That tells us buyers are finally getting exhausted as they approach premium pricing. Because of this, as a disciplined professional, the only acceptable stance here is no trade. We literally just sit on our hands. We wait patiently for multi-time frame confluence. We are not here to gamble in the middle of a range. We simply wait for smart money to reveal their hand at these key levels. Okay, so how do we position ourselves? That brings us to Section 4, Institutional Sell Setup. Here is our primary plan. Scenario 1. We're looking for a sharp manipulation move, basically a classic stop hunt, to sweep the equal highs and that buy-side liquidity resting near 45.15. Our entry trigger requires an immediate rejection following that sweep, which we need to see confirmed by a 15-minute pin bar or a bearish Marabuzu candle. That shows us aggressive institutional displacement. Our stop loss, we're going to tuck that tightly right above the sweep wick. Our take profit will target the 44.60 1-hour demand zone. This gives us an exceptional risk-to-reward ratio, easily exceeding 1:3, and it perfectly aligns with our pro-trend 4-hour continuation logic. But we always need a backup plan. Section 5, Institutional Buy Setup. For Scenario 2, our reactive buy setup, we require a healthy retracement back into the deep discount 1-hour demand block, right between 44.55 and 44.65. Now, we don't just blindly set limit orders here. We wait for a change of character, a structural choke on the 15-minute chart, or a massive bullish engulfing candle backed by volume. Our stop loss will go safely below the 1-hour structural low at 44.40. And for the take profit, we're eyeing that 4,500 psychological resistance. This provides a really solid 1-to-2 risk-to-reward profile, acting as a counter-trend mitigation play, playing off that 1-hour structural leg. Finally, let's cover the exact mechanics in Section 6, execution and risk management. Drilling down into the actual anatomy of this setup on the 15-minute chart, notice that fading momentum indicated by the much smaller candle bodies near the top. But most importantly, I want you to identify that buy-side liquidity. You can see the equal highs resting just above those 4,500 and 4,515 psychological levels. Make no mistake, this is the exact inducement zone smart money is going to target right before they initiate a heavy reversal. As an institutional trader, your execution here requires absolute patience and zero emotion. Step 1, you wait for the stop hunt at 45.15. Literally just let the retail breakout traders get trapped. Don't join them. Step 2, confirm the institutional displacement. We absolutely need to see a definitive candle close. And step 3, only then, once confirmation is locked in, do you pull the trigger, utilizing your strict risk parameters. Equally important is knowing exactly when a setup is dead. Here's our invalidation logic. If we start seeing sideways choppy consolidation rather than clean sweeps and sharp rejections, the setup is instantly invalidated. Also, narrow ranges right ahead of FOMC speakers will completely destroy our risk to reward mathematics, so we avoid those. And if there's no immediate rejection after a sweep, it simply means smart money isn't defending the supply zone, so we stay out. A golden rule here, never front-run the news cycle. Wait for the dust to settle so you can see the real institutional footprints. Remember, capital preservation is always our top priority. The market is definitely setting up for a decisive move, and your edge lies entirely in having the patience to wait for these precise institutional confirmations. To follow future institutional trading opportunities and get more detailed market breakdowns using smart money concepts, you can open your trading account using the link right down in the pinned comment. Stay disciplined out there and ask yourself this: when the liquidity sweep finally happens, will you be the one getting trapped, or will you be the one calmly executing alongside smart money? Keep your risk managed,